Can you see me?
Not yet. You need to click the camera button.
Again, okay. Okay, can you see
Here
me
you
now?
are.
Well, thank you, Alessandro, and good evening to everybody. Thank you very much for inviting me here. Actually, it's quite discomforting to hear that I was at Columbia Business School 40 years ago. Sounds like the other century. It is the other century indeed. Today, I'd like to speak to you about two subjects. The first one is the changes in the business model and the evolution of the asset management industry. And secondly, the COVID pandemic, shorter term and longer term changes that will affect the asset management industry. On the first one, if we give a look to what are the key factors that affect the industry, they are both positive as well as challenging. The positive, we have strong, favorable demographic trends. Aging population, which are providing for increasing financial saving ratio and are in need of decumulation services. We have a constant reduction of pension provision by corporates and state, and at the same time, an increasing complexity of the regulatory framework and the tax framework for pension around the world. Again, on the positive, I would say that we have an untouched ocean of deposits in the banking system in multiple countries, a bit less so in the Anglo-Saxon world, but very much so in Europe and Asia. On top of them, Germany and Italy or Japan, trillion and trillion of idle deposits that are completely unlevered, both to provide growth to the industry as well to be managed by the asset management company. A more recent development, I would say the last 10 years, has been the reduction in yield and consequently the desperate search by institutional investors like pension fund or insurance company that have to match their obligation, as well as individual savers, to find and look for higher yield assets, and so a drive into more complex alternative products or into private assets. And so here you have all a complex dynamics about a change of liquidity and risk level. On the institutional side, it actually started a long time ago. I remember back in 2001, Mike Dobson and I flew all the way to Yale to convince David Svensson, then CIO of the Yale Endowment, to join our board because we wanted to learn from him, especially in how to run multi-asset product. And he did join our board. It was very interesting. Unfortunately, by the end of the third year, he left because he quickly realized that the board of directors is not very much involved in investment decision, but much more in compliance, audit, relationship with the regulators, taxation, and all these amazing and fascinating activities that occupy about half of the time on any board of directors today, and he left. But it was a very interesting experience, and he was the inventor of the new investment strategy that was then followed up by almost every large American endowment back in the 90s. Another key factor has been the changes of investor preferences. And here we speak both about final investors as well as institutional investor. On the final investor, there's been a much more driven demand for solutions. On both sides, there's been a dramatic increase of demand for ESG. And the question has moved from how to invest, from how to invest, to where we want to invest, and how that can have a positive impact on society and on planet. That has been probably the biggest change in demand patterns over the last 5 or 6 years, more so in Europe than in the US or in part of the US. The last factor that is probably more on the negative side is the significant increase on the cost base, driven by the changes in regulation, in transparency, and the cost of technology. On the other side, there's been an increase in transparency of cost, and so in reduction of margin, and in such a way, a compression, increase on cost, reduction on revenues. All these factors together that we've seen in the last 10 years have driven the exceptional success of passive investments, both in the index and the ETF forms, has driven the erosion of margins, the concentration of fund flows on the retail side, and the dramatic growth of demand for thematic investment, of which a key component is the ESG. And finally, because of technology evolution, the explosion of utilization of data science and data scientists within the industry. Passive has grown from being 10% of the total assets under management worldwide in 2003, that were 4 trillion, to 21% or 16 trillion. So it's doubled in percentage and quadrupled in size. That increase is even more dramatic in the United States and in all the asset classes that are very liquid, very transparent, very researched. And that is quite obvious. The last time I gave a look to it a few years ago, there were, for example, 574 fund managers running US large cap. Almost none of them had a consistency of beating the index. So if you are an institution that has a legal responsibility under the new regulation in respect to your pensioner, would you take a risk to pick one of a 570 quite undistinguishable player in the large cap universe? Or you would say, you know what, I pay 5 basis points and I go passive. And that is what has happened with a dry up of flows for most of the active manager in the US, and a significant increase on the passive sector. There is also a bit of hype. ETF were born for a tax arbitrage originally about 20 years ago for institutions or corporate investors. There are some specific issues that in a downturn you could say, it's like the widening of the margins, liquidity aspects in the less liquid markets like high yield. There are some sometimes challenging evolution within the index. Think this year about the component of technology. So they've been a great tool for the development of industry, but at the same time, they have some probably underestimated challenges. But overall, I think they're here to stay and probably will grow more. Some estimates is that they will get to about 1/3 of the industry by 2030, by which point the same fact that so much money is going into indexing should create some interesting opportunities for the active manager, or at least for the good active manager. Probably less influenced by this explosion of passive have been those operating in private assets and in alternative strategy that have proved much better resilience because of the nature of their own portfolios. Erosion of margins. Just to give you an idea, when I arrived to London, we had a portfolio that was overall across all of our assets, about 70% equity, 30% bond at shoulders. It was already quite global. And we had a weighted average return on assets net for us of 104 basis points. I'm talking about liquid assets, public funds. And we were selling to institutional investors emerging market equity or emerging market bonds at 100 basis point and 75 basis point, not accepting anything less than $100 million, because we couldn't even think about accepting a smaller amount. Now, the world has changed quite significantly from there. Competition has increased, transparency has improved, and with some notable exceptions, like in retail Italy, similar to probably Taiwan and Korea, because there are a battalion of financial promoters to be remunerated in the streets that keep the total expense ratios of the funds quite high. Overall, around the world, the prices have gone significantly down, more than halving from the numbers I was giving you before. Now, the effect on P&L has been smoothed in the last 10 years because of the effect of the asset value increase. But once the market will recede, and inevitably one day will do so, you will see the full effect on the P&L. At the same time, as I mentioned before, cost of technologies have increased, as well as the cost of the governance function, internal audit, anti-money laundering, risk, compliance. So the effect and the challenges to P&L of the companies are there. Concentration of flows. So the concentration of flows have clearly been more visible in the US, but it's coming to Europe as well. There is every year a very interesting study from BSG that demonstrates that for the US, the very few funds, active funds, that they've been able to retain positive flows in the last 5 years have been those that are 5-star. The 1 to 4 stars have all been negative. So that is a clear trend, and it's driven both by intermediary as well as by retail demand. I'm talking here about mutual fund now. Another of the key factors I've hinted into and that have been changing the industry has been the development of the thematic strategies and within that of the ESG. Now, some companies have built their fortune on thematics. Think about Pictet. Thanks to Arnaud de Plantard and Laurent Ramsey, they have developed thematic strategies back 10, 12 years ago, starting with funds and strategy like the Water Fund, that has been a key success for them in Japan, for example, to robotics more recently, that has performed very well. And it has been so successful that they're now starting to distribute and sell it in the institutional world as well. So when you think about Pictet has a very clear strategic position in the market. It's a global winner for thematic funds. And building a company, being very clear what you stand for, why people would come to you, it's one of the most important aspects in any business strategy. They are now working and developing on alternative investments, but thematic has been a key winner for them. There has been also smaller company in other sectors. I can think of Ambienta in private equity in Italy, a clear position, a niche positioning that's gone from a small fund at the beginning to €1 billion new funds that are raising now, which is, I think, their 4th, and clearly doing well. And it's, again, very clearly strategically positioned. The ESG theme is part of the thematics, but it goes far beyond thematics because it has become a strategic imperative. Last year, it overcame $30 trillion worldwide. And almost every houses are now adopting it, not just as a strategy, but as a standard component of the portfolio selection and of the overall investment process of any strategy. And actually, if you are outside of it, you are cut out by many institutional investors. Pictet, Schroders, M&G, all the three companies, or the large one that I know well, are fully embedding that, and it's going from passive screening to active selection. Now, going into active selection requires a development, a very significant development. I think it's very important, which is the definition of ESG, because up to now, some investors have their own definition, some companies have their own definition, and we risk to end up like the Sharia investment strategies. I remember, because I, as a global head of distribution, I traveled frequently to those regions, and we had an investment strategy that was good for the religious leaders of Saudi Arabia, but that was different from the one in Abu Dhabi, completely different from the other one in Indonesia or in Malaysia. So we are never able to build economy of scale or a product that could be sold across all the Arabic world, because there were tens of different definitions of what was a good Islamic strategy. Now, with ESG, we need to avoid this because it's so much bigger and so much secular as a change. That I think the Investment Management Association should work hard together to try to come to a common definition. And that is extremely important, because over time, you don't see not only the beneficial effect that you are having on portfolio return, as we've seen recently for those companies with good governance, but you see the benefit on society and on the planet eventually, because among other things, it's increasing the cost of capital for the companies that are outside of ESG, and increasing their cost of capital, you're putting them at a competitive disadvantage. So this is really one of the strongest trends that will affect the capital markets over the next 20, 30 years. Last but not least, the data set utilization. Now, the capability to buy, analyze, and structure unstructured data set that you can find everywhere, from retail tickets in supermarkets to geographic and weather. It's becoming a key and very important aspect of any business, especially more so in as much as the artificial intelligence is being developed and embedded in investment processes. I'll give you two examples. Back in 2014, Schroder hired a McLaren data scientist. Formula One, like supermarkets, are at the top end of utilization of data. And we started to develop a small team that analyzed the investment decision, thousands and thousands of investment decisions for each investors. And that was very interesting, because it started to separate which one were good investors, but that had given interesting or positive results because they were in the right part of the cycle, they were at the right place at the right time, they had a cultural bias, or they had a psychological bias, and that were worth having in the company, but were different from the genial superstar investor that were really able to create value in any circumstances, that were the $10 million investor. And so that helped us a lot to understand the people that we were working with, as well as we started to develop a correlation and automatic analysis of the clicks on our website with our customer relationship management system, Salesforce, in such a way to inform our people when we would understand that our customers were concerned about something or interested about something, and then immediately follow up in a very proactive way to either protect the deal or close the deal. These data are expensive, and for most firms, meanwhile, a whole industry has been developed of people that buy wholesale, manage the data, and sell them retail once they are structured. And they offer to private equity firms, hedge fund, but as well as they can do it to supermarket chain themselves. One of them, I invested a token into it a few years ago. It's Eagle Alpha, and there are many, many of them today in the market. There are other companies that have built their model and their success in managing factor through data set and artificial intelligence. Names that everybody of you will know are Renaissance Technologies, Two Sigma, Citadel, and so on. I remember about 10 years ago, we went to visit this, at the time, a relatively small and secretive firm called Two Sigma New York, having left my telephone, my iPad, my computer, my watch, my pen, almost everything at the entrance in a safe box, otherwise I couldn't go up the stairs. We soon discovered that the small firm was making more profit than us, and so rather than us trying to buy a stake in them, we immediately diverted to a much smaller joint venture to distribute in a white label format one of their delevered products for the intermediary market in Europe, which actually has gone quite well. They basically try to find correlation through the work of 300-400 scientists, and they build factors, and they build a portfolio of factors. Some of those factors last for 2 or 3 days. Others never work and are taken out of the pie and substituted by another slice. Others last month or last year. To be very effective, already at the time, Two Sigma had 3,600 servers. This was more of the whole capacity, all the asset management industry in Europe. And they were positioned near all the exchanges. They were not high-frequency traders, but the speed and quality of execution was very important to the success of their strategies. And basically, the core of their products that today are sold only and invested only by the partners and employees, everything that is offered to the client base are component or delevered version of those core products. For example, Two Sigma was to keep, maintain, develop strategies that yield around, target around 8% return per year with 2% volatility. Then they levered 4 or 5 times, hence they developed 30 to 40% net return per year, and along the way they made all the partners and most of the senior managers billionaires. Good luck for them. The use of data has been also very important in developing the wealth management space, not only to service the client, but to help to build business models. Think about Betterment in the US, Nutmeg in the UK, Money Pharma in Italy. We actually invested in Nutmeg. I sat on its board for a few years. Very interesting, very difficult to make money though, yet, because the investors are small in size. The growth rate necessary to be retained as a digital company rather than a wealth manager, and consequently to be paid on a price as a multiple of revenues rather than a multiple on EBITDA, requires 50 to 60% growth per year, and so constantly losses because the acquisition costs are significantly higher than the revenues generated by clients in the first year or two. So the more you grow, the more you lose, but you increase your value, classic digital format. But that's an evolution, and this of the data set utilization will be one of what I think the 2 biggest battleground worldwide over the next 5 to 10 years. Company that will be successful in creating efficiency and building it into their business model and into their investment processes will have a clear competitive advantage. So given those long-term secular factors and the consequences, what are the solutions that the company have adopted? Well, they're not dissimilar to those that are in every other industry. You try to create economy of scale, so through merger, trying to achieve, for the global firms, I'm now talking here about global firms that are multi-product, multi-country, and multi-channel, to achieve at least 8 trillion in sales and the 3 to 5 billion in revenues. The recent example have been Janus Jupiter a couple of years ago in the UK, Standard Life, and Aberdeen, less successful probably. Because at the end, this is a people business, and the culture is extremely relevant to its success. And so the most crucial challenge in any merger is when the culture of two companies are very different. Other solution have been to build a low-cost business model. Worldwide champion, Vanguard, extremely successful, extremely successful. Of course, they have a big advantage in not having shareholders, being a cooperative, but they also have some active product. I remember we did manage some of them at very low margins, but they are outsourced. Their core is in passive and distribution, first-class company. Legal & General in the UK. Part of the low cost of the search for low cost has been the significant increase for every company here now across the board in outsourcing. And a lot of specialists at scale in service provision have developed over the last 10, 15 years. So you have moved from a tradition of outsourcing custody, fund accounting, transfer agency for many. You now have the outsourcing of a full back office or the full middle office, in some cases, including execution and deal trading. So the company are trying to focus on where they have scale and where they really add value to retain the cost base at the lowest possible. Other solution have been the geographical diversification, but actually by the big global player has been already done, and for the newcomers to build it today, it's more difficult because it's, of course, much more crowded. The real change, the real defining one will be China. Notwithstanding its governance difficulties, the complexity of a multiple license type of permission that you have to accept there and apply for, that is in a longer term perspective the largest potential untapped market. It won't be let to foreigners that much, but even the part that will be open for competition, I think it would be extremely significant and certainly much bigger to the other Asian market, which are quite developed and very crowded. On top of it, Australia is extremely competitive and crowded. There is then probably another solution, that is the positioning in niches, or building as a sum of niches. That has been probably better done by American firms, a lot of them starting from private assets. I think about Apollo or BlackRock. Of the Europeans, only the Swiss Partners Group I can think of as a very successful one. Today has a market cap of about 12 billion Swiss francs. it's much more difficult, and I've experimented in first person already in 3 companies, for a large multinational liquid markets expert company to develop into private assets. There are not only cultural aspects, but the role and the self-contained of this entity that do sourcing, origination, management, and divestment of initiatives. And that comes with significant remuneration issues, because the mechanism with the carry, the subdivision of the carry, are very different from the one in the liquid side, and it has always been a challenge. Think that Schroeder had Schroeder Ventures back in the 90s that was spun off to the management to become Permira, one of the most successful firms of Europe. But then it was, for this exact reason, was thought that it was too difficult to manage and retain and attract top talent in the organization. To then start to build it back 4 or 5 years ago, when market demand went overwhelmingly in that direction. On COVID, it's interesting to see 2 aspects. What are the effect on the market flows, and what are the effect on the companies? I think here I'll be probably shorter. On market flows, I would say that institutional markets have been quite muted, and that's in their nature. They don't react in panic. They have a longer-term perspective and longer-term investment plans. So I haven't seen any significant change. In retail, January and February were quite positive. Here I have data for Pan-Europe, because many of the Pan-European registered funds are sold across Asia. This is a significant part of the world, and I would assume that the US are not dissimilar to this one. Panic selling in March. Interestingly, there's been panic selling out of money market as well, which puzzled me a little bit. But you had 300 billion of outflows in March. Overall positive any other month from April onwards until the end of August. Only one component was negative, that was in April equity. That was probably a bit of profit taking after the short comeback that we had seen during the month. The strongest month has been July. And if we think about what has happened, then year to date, all the flows in Pan-Europe, in mutual funds, are positive. With money markets quite large, 271 billion, people still undecided where to put the money. But across ex-money market, they're also positive for 62 billion. So interestingly, the investors have very similar position to where they had before the beginning of the crisis, as well as the institutional investor have very similar position, maybe with some marginal restructuring of the portfolio construction. So we could say muted effect from the investor base. Clearly, we are only 7 months in what could be a 2 years effect, and it's rather early days. I would be prudent in saying that we are over it. We are just into it, and we have to wait a little bit more. What has surprised everybody is the resilience of the industry, which had the capability to move tens of thousands of people online, working from home in any sector of their activities: analyst, fund manager, trader, business developer, accountant, everybody. I was actually amazed. I lived into it. I was just joining the board of M&G, and I was actually amazed by the capability to transform the company in what people would have thought it was a multi-year task to be implemented. This will have unquestionably affect in the organizational model of the future. I personally don't think that the company will move into home working 100%. I think that the model that will become most adopted in our industry will be a significant flexible work, part-time model, where people can choose to when they think there is a meeting is important, when they have to go to discuss with their colleagues, and when they can work from home. If nothing else, because it's relatively easy to manage the existing, is much more difficult to build the new. And you miss the creative brainstorming and appropriation of the ideas that you just would have walking into the corridor, talking to someone during the coffee shop, debating in a meeting. You grasp a lot of, I didn't think about that. That's a good idea. Let me do that. And this is part of daily life. And being alone in a room, you don't have that effect. As well, it's very difficult for the newcomer, for the young people that are starting to work in the company, to understand the company, to understand the personality of people they work with, to understand the culture of the organization. So I think the mixed model will probably be the winning ones. And I know for sure, because I spoke with the person in charge, that some of the public information about some asset manager going completely home working were clearly overstated by the press to make the title of a day. Certainly, this will accelerate all the effects of digitalization and outsourcing that were already in progress. And probably we will see in 2 or 3 years what would have been implemented in 10 years, over a decade. That has, however, put much more the focus on the protection and security of data, on the location of the servers of the clouds, and on the velocity and trustability of the Wi-Fi network that individuals use. And that requires a lot of work, because some of it's related to country infrastructure, and it's about fibers, and it's about 5G. But all these evolution will bring significant changes to the operating model of the companies. Now, what are the economic effects then and the prospects of the future of industry after this quite long conversation? Well, I see sometimes people that are tearing their hair because they say, oh my God, our cost to income is too high, our profit is becoming too small. Well, think about this. In the last decade, large global multi-asset players operating in multi-channel had cost to income that went from 50 to 60%. So pre-tax profit was 40 to 50%. Now they're desperate because they see 35. Now, even if it went to 25, try to talk to our industrial friends or the companies we invest in and say, would you be happy about having a 25% margin on your business, on your revenues? They would start dancing on the table, opening the champagne and kissing you all over. Now, I think this is an industry that has still today a fantastic margin. That is challenging, but whenever I worked in any company, for myself or for large groups, I had to manage change. And to be successful means, as a manager, being able to manage change, because every day there is change. Now we are probably in acceleration of change, but it has always happened, and it will always happen. But this is an industry that is creative, is full of talent, will continue to attract talent, remunerates well, maybe without some exaggeration that we've seen in the past, but continue to remunerate well, that has has very decent working hours. And overall, it's a fantastic place for a new generation to work into. That's all I have to say. But open to your question.
Wow, wonderful! I mean, it was simply amazing, the breadth of the topics that you walked through us.